Question 21, Coeden. So in this question, we are going to discuss what question? Guess. It is cost of capital. We are going to discuss cost of equity, cost of debt, and cost of capital, WACC. We are going to calculate WACC. Let us read the requirements first. So calculate and comment on. It's just not the calculation part, but we need to comment also. The Coeden company's cost of equity and WACC before and after implementing the proposal. Briefly explain any assumptions made. So here are a lot of things to do. We have to calculate and comment on cost of equity, the WACC before and after implementing. That means we have to calculate two cost of equity, two cost of debt, two WACC, because WACC will only get when we get cost of debt also. Right? They have told cost of equity. That does not mean that we don't have to calculate cost of debt. We have to, because then only you'll get your WACC. Both before and after. That means we are going to have two cost of equity, two cost of debt, and two WACC. We have to compare, we have to comment, and also we have to give assumptions. 20 marks. Right? Now you have to be very smart enough to get this 20 marks. What are the steps you need to do? How to calculate? Okay, coming to part B, discuss the validity of the assumption that the market value of equity will remain unchanged. Okay, after the implementation of the proposal. So they are saying you have to discuss the assumptions, the validity. How validate is your assumption? That the market value of equity will not change before and after the proposal. 5 marks. This type of question is a little tricky question and it's hard to get points and answer. But no worries, I'm going to tell you how to come to this point. How to write. Okay? But before that, we have to go to the case study. Right? So starting with the first para. Coeden Company is a listed company operating in the hospitality and the leisure industry. Coeden's board of directors met recently to discuss a new strategy for business. The proposal put forward was to sell all the hotel properties that Coeden owns and rent them back on a long-term rental agreement. So what was the proposal? Remember, we have to find WACC before and after proposal. So the proposal, you have to understand what is the proposal all about. Okay? Proposal is sell all hotel properties that Coeden owns and rent them back on a long-term rental agreement. So this is the proposal. Coeden would then focus solely on the provision of hotel services at this properties under its popular brand name. So then they will focus solely on the provision of hotel services. The proposal stated that the funds raised from the sale of hotel, since they are going to sell all the hotel properties, so the fund which they are going to raise from that sale of hotel properties would be used to pay off the 70% outstanding non-current liabilities, and the remaining funds would be retained for future investments. That means out of the fund, okay, they are selling the hotel properties, all the hotel properties, for which they are going to get money. Using that money, they are going to pay 70% of their non-current liabilities, and the remaining 30% they are going to retain it so that they can invest in the future. This is the proposal. Pay off 70% outstanding non-current liabilities, okay, and remaining funds retained for future investments. Coming to second para, the board of directors of opinion that reducing the level of debt in Coeden will reduce the company's risk and therefore its cost of capital. If the proposal is undertaken and Coeden focuses exclusively on the provision of hotel services, it can be assumed that the current market value of equity will remain unchanged after implementing the proposal. Okay, now going to the financial statements. Okay, we can see we have non-current assets, we have current assets, share capital reserves, non-current liabilities. Right, the non-current liabilities is 5.2% redeemable bond. Now coming to the information. Coeden's latest free cash flow to equity of $2,600,000 was estimated after taking into account taxation, interest, and reinvestment in assets to continue with the current level of business. Okay. Free cash flow to equity is this much after taxation, interest, reinvestment in business. Okay, it can be assumed that the annual reinvestment in assets acquired to continue with the current level of business is equivalent to the annual amount of depreciation. Okay, over the past few years, Coeden has consistently used 40% of its free cash flow to equity on new investments while distributing the remaining 60%. So 40% of free cash flow to equity on new investments, remaining 60% is distributing. The market value of equity calculated on the basis of free cash flow to equity model provides a reasonable estimate of the current market value of company. Now, the bonds are redeemable at par in 3 years' time and pay the coupon on an annual basis. Although bonds are not traded, it is estimated that Coden's current debt rating is BBB but would improve to A plus if non-current liabilities are reduced by 70%. Okay, redeemable in 3 years' time. It changed from BB to A plus. Okay, this you need to understand. Their current credit rating is BBB but would improve to A plus if the non-current liabilities are reduced by 70%. What does it mean? Can you link this to the first para we read somewhere that when they are selling the hotel property, they are going to get money. That money they are going to use to pay off the 70% non-current liabilities. That means they are talking about, in short, what are they saying? Under the proposal, new credit rating. So that means if you go by the proposal, your credit rating also will change from BBB to A plus. That's what it means. That's what it means. Why we are worried about the AAA and A plus? Because of cost of debt. Your cost of debt depends on this rating. Your cost of debt will change, and so will your WACC. Coming to other information. Now, other information is very important. Okay. From here, most of the workings will be based on your other information only. Okay. So, Coden's current equity beta is 1.1. Equity beta is 1.1. The current. And it can be assumed that debt beta is 0, right? We know that even if it is stated or not, we always assume that debt beta is 0. So the risk-free rate is estimated to be 4% and market risk premium is 6%. So risk-free is 4%, risk premium is 6%. Why is this piece of information is given? Write it somewhere in front of your answer. CAPM to find cost of equity. This will save your time. You exactly know where to go when you're writing the answer. This is called annotating. You're writing towards it what is important from it. What is important from this paragraph, from this text? You're writing in short sentences so that you understand, right? Risk-free rate, risk premium, beta is given for you to find cost of equity. Now coming to the second para, there is no beta available for companies offering just hotel services. Now read this sentence line by line because most of the students struggle in this part. The second para, understanding is very important. If you understand it in a wrong way, you are exactly going in a wrong direction. Yes, technically you are doing correct things. You are right, using the right information, the right formulas and all. But it is wrong. If your interpretation is wrong, everything goes wrong. So there is no beta available for companies offering just hotel services. Just hotel services. Why we want about hotel services? Because they are going to invest. After selling all the hotel properties, they will only be focused on hotel services. Do we need a beta for that? Of course we need a beta for that. Because otherwise how will we find WACC? Right, we want back after proposal, right? After proposal we just have hotel services, so we also need to find beta. But read, since most companies own their own buildings, the average asset beta for property companies has been estimated as 0.4. It has been estimated that hotel services business accounts for approximately 60% of the current value of, so hotel service businesses 60% of current value of Coeden and property business 40%. Okay, whatever the current value of Coeden, out of that 60% is for hotel services and 40% is for property, the one which is sold off. Okay. And average asset beta for property companies. Now you have been given for property companies the asset beta. But what is our thing? We want for hotel services. We just want for hotel services. Okay. Now coming to the last para, yes. Coden's corporation tax rate is 20%. Okay. Tax is 20%. 3-year borrowing credit spread on A plus rated is okay. Of course, you will be given the rate. Okay. A plus is 60 and 90 basis point for triple B over the risk-free rate of interest. Over the risk-free rate of interest. What is the risk-free rate of interest? Risk-free rate of interest, if you can see, it is here 4%. Go to your first para under the information. This 4%. This is your risk-free rate. So with this 4%, you have to add your basis point. Now it looks clear. So coming to this, I have the marking scheme and I have this also, but I will not go through this right now. I will show you at the end of the video. Now, first, what is the starting point in this question? The starting point is always before, not after, before implementing proposal. So this is your subheading. Now what do you need? To finding WACC. Okay, you need 4 things. This is for all those type of questions where you are required to find WACC or cost of equity before and after proposal. You have to find 4 things. Number 1, number 2, number 3, number 4. Cost of equity, cost of debt, market value of equity, and market value of debt. These 4 things you require both before and after implement. This is before. This is after. Same thing. All this 4 will be repeated. 1, 2, 3. 1, 2, 3, 4. It will be repeated as before. So your starting point is cost of equity, cost of debt, market value of equity, market value of debt. These 4 things you have to find out. Right? Now it is up to you. What do you want to find first? Cost of equity or cost of debt or market value of equity or market value of debt. Anything you can find in any order. There is no fixed order that only this only you can find. You can start in any order. But in the paper, if you see, they always start with the easiest one. The one which you have direct information, which easily you can take. Right? Where you don't require workings and all. Those information, they usually calculate first if you see the marking scheme. Right? They don't waste so much of time, because in the exam also you don't want to waste so much of time. The easy ones you want to write as soon as possible. So just check which one is the easiest one for you to calculate and use those, write those. Okay, here you can see they started with cost of equity. So cost of equity is number 1, cost of debt is number 2, market value of debt is number 3, and market value of equity is 4. It could be in any order, but market value of equity is the last because you have to do many workings under that. It's not easy. Directly you cannot get market value of equity, but we'll come to that later. Now cost of equity directly you can find using CAPM. Nothing to change before implementation. Cost of debt, your equity beta was 1.1, risk premium was 6%, and risk free was 4%. Using that, got cost of equity. Coming to cost of debt. Cost of debt, you just have to add risk free rate plus your bond when it was triple B. Remember, when it was triple B, it was 90 basis point. Don't go and add a 60 basis point with 4%. The reason why is because most of our thinking is like this, that when something is given first, that means it is before, and when something is given later, it is after the implementation. No, it is A plus rated, which is 60 basis point. A rated is after the proposal. So before it was 90 basis point. Just check which basis point is for which ratings. It is easy to get confused. Let me show you here. If you see this A rated bond is 60 basis point and 90 basis point on BB. So if you think that, you might get confused if you don't read this part. Okay. So it is 90 basis point. That means it is 4 plus 0.9, 4.9. This is easy. So this is calculated. I will put a tick mark. This is calculated. Coming to market value of debt. Market value of debt is easier to calculate than market value of equity in this question. So directly we can go. Okay. Okay, the bond was redeemable in 3 years time, correct? And what was the cost of debt? We calculated we need the cost of debt, remember, which is 4.9% in this case. So that means this shows you that cost of debt has to be in this situation, okay, not always. Cost of debt has to be calculated before market value of debt, because you need that cost of debt to calculate market value of debt. Just see your denominator, you're using it. You're using the cost of debt to find the market value, right? 1.049, 1.049 to the power 2 for the second year, and this is for the third year. Okay. Why 5.2? Go to your balance sheet, check 5.2% redeemable bond. 5.2%. That's why if you see, you have to be very this thing. First year it will be 5.2. Second year also you are paying 5.2. Third year you are paying 5.2 plus 100. 100 and 5.2. The principal and the interest amount together. And this is your market value of debt. But market value per bond, you have to find the total value. Total value is required. What is the total value? This amount, whatever the amount you get, it's always this method only. Market value of debt, okay, which is 100.8 to divide by 100 into 42 million. Why 42 million? How you got this 42 million? Right, this is the amount. This is the market value of debt which you have to use in your WACC calculation. 42 million. We'll go and check the balance sheet. It was 42 million. Just see from the balance sheet. 42,000. But just don't forget about the other 3,000. That means it is 00042 million. You cannot go and write 42,000 there. Write the whole amount. In the balance sheet, when you're presenting, yes, you're writing as 42,000. But it means when you read, you will be reading it as 42 million. Okay. Now coming to the market value of equity. Here you need lot of formulas are used in this market value of equity. So market value of equity, as stated in the question, the free cash flow to equity model provides a reasonable estimate of the market value of company. This has been given to you in the case study, that free cash flow of equity is a free cash flow to equity provides a reasonable estimate of the market value. So that means you can use free cash flow to equity assumption. Wherever you can, you have to make assumptions. They told you, state your assumptions. So what is the assumption? First assumption is this: the growth rate can be estimated using the RB model. They're talking about the growth rate. Whenever market value of equity comes and free cash flow to equity comes, growth rate, you have to talk about growth rate using RB model. Okay. Market value of equity, free cash flow to equity, when you are given free cash flow to equity, you have to talk about growth rate. Because I will write here FCFE. We'll understand. Okay. Why? Look at this formula. Because of this. If you see, the formula is this. The formula of market value of equity is what? Free cash flow into the growth rate, okay, divided by the cost of equity minus the growth rate. So that G, how is it estimated? Using the RB model. And it is assumed that the retained free cash flow to equity, retained, how much it is retained? Why they told about retained? The very reason why they used that word, how much they are retaining, is for you to find this equation. Because this equation means what? How much you're retaining. You need a value of R means what? Retention. How much you're retaining. So this word tells you which formula to use. That's why they have given you that word, retained. How much cash flow they are retaining. So it is retained at the assumed. It is assumed. Please always write it is assumed. Okay. Because when you're writing under assumption, that the retained cash flow, free cash flow to equity will be invested to generate a return at least equal to the shareholders' required rate of return. Shareholders' required rate of return. This is cost of equity, which was just above we calculated using CAPM, which is 10.6%. It will be equal to this. Okay, so your R, I'm sorry, R is the cost of equity, right? The rate of return required by shareholders, and B is the retention. I'm sorry, B is the retention. Okay, so 10.6% is for R, and B is what? Retention, 0.4. That means 40% you are retaining. We'll go and check. Still, we'll go and check again. Okay, where they told yes. So 40% of the free cash flow to equity on new investment while distributing the remaining 60%. So 60% will go as a dividend, 40% only they are retaining. So 40%, that's why 0.4. Always when you study, also understand the meaning behind each figure. Why this figure is given here? Why this figure is given here? Don't try to memorize it. Okay. Memorize will not lead you anywhere. So B R into B is the formula for the growth, which is this 4.24%. Now using it, you can calculate. What was your free cash flow? Hmm? Free cash flow was 2.6 million. It is free cash flow, not free cash flow to equity when you're using this 2.6 million. Okay, but it does not matter because you are discounting this by what? Cost of equity. See this. Free cash flow to equity you are using to find the value of the company. You have to use cost of equity, not WACC, not cost of capital. Okay, 2.6 million it has been given here. Yes, sorry, latest free cash flow to equity. Yes, it is free cash flow to equity, sorry, not free cash flow. So one mistake they have done here is at the end it's E. So that's why that confusion comes. Why FCF? It is FCFE, not FCF. Sorry, it was a mistake there, okay? It is a printing mistake. So FCF into G divided by KE minus G. Whenever E is there at the end in an equation, this has to be KE down. When it is FCF, free cash flow to not just free cash flow, then it will be divided by cost WACC minus growth. So your free cash flow to equity is 2.6 million. Growth is 4.24%. That's why you multiply by this. Divide by cost of equity was 10.6 minus 4.24, the growth. And you are getting this, which is rounded. When you are rounding a figure, write that you are rounding it up, rounded. Okay. Now, what is the proportion of market value to market? It's close to 50-50. Close to, see, nowhere in this case you have been given the proportion of equity to debt. Usually they give you. But there are instances also where they don't give you the proportion. You have to see how you are getting it. So in that case, we know the market value of equity, we know the market value of debt. Just check. What is the market value of equity? I will write it here. Market value of equity, market value of debt. What is the market value of equity? 42,614,000 here, going up. Market value of equity. Okay. 42,344,400. If you see, it is very close to each other. It's almost like very similar. That's why they are saying the proportion of this is close to 50-50. It is not exactly 50-50. Okay. But it is close to 50-50 if you see the amount. So based on that, which will be used here to simplify the calculation. Whenever you are in a situation like this, it's better to use it if you see something is very close to this. Use it that way only for simplification purposes. It's easier to work that way. Don't try to find exact number and break your head. Okay, how much it is exactly. Don't do that. So back cost of equity 10.6%. Portion of equity is 5%. Cost of debt 4.95% into 0.5 because 50-50 and 0.8 because tax. Tax is 20%. 1 minus 20% is 80%. And WACC you are getting 7.3%. Make a note of this. You have to find WACC after and then you have to compare whether it increased or reduced. Coming to after implementing the proposal. Write it. Write the subheading. Before, after. Don't just start writing with the numbers and all. Okay. Now, here if you see, it looks very different. Here you can see they're starting with asset beta, then equity beta. They are not starting like this. Cost of equity, cost of debt. Okay, the reason why is that is you cannot find directly after implementing. By using a CAPM, you cannot find your cost of equity directly. Here also they are finding cost of equity, cost of debt, market value of equity, market value of debt only. But their starting point, they cannot directly use CAPM and find cost of equity. Because to do that, you need equity beta. And you are not given the equity beta as it is for the hotel services. You are not given. You have to do a lot of working here to find that beta first. Then only you can use CAPM and find cost of equity. And the rest follows. So for that, you need to be very good in re-gearing, ungearing, and all those things. So in this case, the starting point is what? What is the starting point? Asset beta. Asset beta is the starting point. Okay. So let me write these points. Asset beta for hotel services only. Because after proposal, you just have hotel services. Then comes equity beta. From asset beta, you will get equity beta. Only for hotel services. After equity beta, you will get cost of equity using CAPM. Then rest all follows. 5, 6. Cost of debt, market value of equity and debt. Okay. But you have to find asset beta and equity beta first. You cannot directly jump to cost of equity. Okay. So starting with the estimate of asset beta for Coeden is given as. Okay. This is based on the formula which is there in your formula sheet. The formula for what? Asset beta. So the formula for asset beta is this. I don't know where should I write it. I'm writing on the left hand side, so please follow. Asset beta is equals to equity beta multiply by, okay, this is E. Equity beta into what? Market value of equity divided by market value of equity plus market value of debt. This is the formula. So exactly that formula only I'm using here. What was the equity beta? 1.1. But this 1.1 equity beta includes both. It is before the proposal. That means it includes both hotel services. Now you see, you have to be very smart to use equity beta. Okay, 1.1. Okay, which is this, the current equity beta you have to use. Okay, most of you, what do? You go and put this 0.4, this average asset beta there. Wrong. It is not asset beta, it is equity beta in the formula you have to put. Just don't think that since 1.1 we have used in CAPM before the implementation, we cannot use it anywhere else. If we have used one number somewhere else, we can still use that number in another calculation. Okay, so that 1.1 job is not over, still we need it. So it is equity beta and it is before the proposal. That means it has both the hotel service and hotel property. From here, your job is to separate. Just only you have to find the hotel services. 0.5 because the proportion of equity is 0.5, and then divided by, which is your denominator, the down part, value of equity 0.5, value of debt, I mean the proportion of market value of debt is also 50% into 0.8 because tax you have to take after tax, and then you are getting 0.61. Mind you, this 0.61 is the asset beta for both hotel services and hotel properties. Let me write it here. You are selling hotel property, you have to separate out and only find for hotel services. So asset beta for hotel services only. Next comes that. Don't go and start writing equity beta. You cannot find equity beta if you haven't found asset beta. Remember that. So next job is to find asset beta for hotel services. Please follow on the steps. Knowing which comes after the next is also very critical. Okay, so it has been assumed. Always write your assumption. Whichever places assumption has been there, you have to write. Asset beta also assumption is there. What was the assumption? It has been assumed. Okay, you can even memorize these assumptions because these assumptions are always same only. Doesn't change. It has been assumed that Cohen's asset beta is back weighted average of the average property asset beta and the hotel services beta. That means they are saying that asset beta, that 0.4, which they calculated, it is the weighted average of the average property plant beta, and hotel services beta. Therefore, okay, so based on this, therefore, you're saying, what is 0.61? 0.61 is the combination of both. So asset beta of hotel services into this asset beta of property into property. What was asset beta of property? We know it was 0.4. They have given that 0.4. Average asset beta for hotel properties. Right? And the proportion of hotel property was 40%. Okay, we'll check. Just check here. 60% of current value of Coeden and property accounts for, and the property accounts for remaining 40%. That means 60% is for hotel services. And if you say average asset beta for the property, average asset beta for property means property is 0.4. So 0.2 proportion of property. And then the balance 60% is for hotel services, but we don't know the asset beta of hotel services. Just leave it as it is. You can use algebra also and find it out. Okay, asset beta into hotel services, which is hotel services into proportion of hotel services. Now you know how to calculate the asset beta, right? You just have to interchange and make it the subject and all those things. Then asset beta for hotel services 0.75. 0.75. Okay. Let me tell you how this is 0.45 for all of you who don't know still. So this is 0.61 and 0.4 into 0.4 is 0.16. You take this 0.16 on the other side. Here it is plus. On the other side, if you take, don't divide, okay? You have to be, this is, I don't know what to say. You might be very bad in maths in school if you're dividing it. Okay, by just seeing this multiplication. No. Multiply this by this and then you have to minus it on the other side. So 0.61 minus 0.16 becomes 0.45. Okay, and this asset beta into 0.6 remains as it is. And then finally 0.45 divide by 0.6, you will get 0.75. Okay, now based on that, now we can find equity beta. So market value of equity is unchanged as stated in the question. They told that market value of equity will be, it will not change. It will remain same. Let me take you there where they have told that. Okay, somewhere they have mentioned about it. Okay, it can be assumed that the current market value of equity will remain unchanged after implementing the proposal. So market value will be same as before only, which is this. From before implementing, this is what we got. Use that as this one. And now cost of debt 4, just say this is 0.6. Now it reduced. It is now 60 basis point because you change from triple B to A plus, which is 4.6%. Now cost of debt reduced. Now market value of debt again is the same way, just this cost of debt will change. 5.2, 5.2, 100 and 5.2 because 100 plus 5.2. Okay, and this same the total value. Okay, we'll come to this later. It will be 101.6 divided by 500 into 12.6 million. Why 12.6 million? Why 12.6 million? We are paying 75% of the long-term liability. What was before? Okay, before the debt was how much? 42 million. 42 million into 75%, sorry, 70% we are paying. That means we only have 30% left. 30% non-current liabilities we are paying off. So that means we are left with 12.6. That's why it's 12.6 million. Don't go and put 42 million here also. Okay. Now coming to equity beta calculation, here also that formula only. You have to know the formula. So here asset beta, just now we found this is asset beta by okay, 0.75. Now equity beta into, okay. Now one thing you have to note, another thing changed. No 50 is to 50, wrong. This is not 15 to 50 for this one after proposal. Why? Check this. and check the market value of equity. Market value of equity was 42,614 million, right? 000. Is it 50-50 now? It was before 50-50 we took. Now it is not 50-50. So now if you are again taking 50-50, you are doing a big mistake. It is not 50-50. You are taking the value of market value of equity and debt as it is. That's why this is 42,614 and this is this plus this into this. Just follow the formula. And then we all know how to get the equity. Okay, if you calculate all this, it will be 0.806 and then 0.93. Make sure that your equity beta is more than asset beta. This is more than asset beta. Asset beta is 0.5, equity beta is 0.93. It should always they should remain. Coming to hotel services, cost of equity and WACC, we found everything. Just check before you go whether your market value of equity, market value of debt, cost of equity, cost of debt, all this four component has to be there for you to find WACC. If all are there, next step is find WACC. Okay, but one thing we didn't find, cost of equity. So cost of equity, now we found the equity beta. Next step from here is this 0.93, market risk premium is 6%, risk free rate 4%. So this is your cost of equity. But now coming to WACC. So this is your cost of equity 9.6. Proportion of your equity to debt. Equity over equity plus debt. Then your debt, cost of debt into 0.8 because after tax. Then proportion of debt over equity plus debt 8.2%. So all the calculation part you are done. Right? And one more thing which I want to tell before I proceed for the comments. There is a way of checking whether your this asset beta is correct or not. Okay, that way is insert this 0.75 here. After you have this habit of checking it back, so that if you know you are correct, you become more confident when you are going ahead for that question. This increase your confidence that you are correct, you are very sure that you are correct, you are not using any wrong figure or something. And it also reduces your panic mode, because we are always in a fear that what if I'm wrong, what if I'm wrong, because we are not sure whether we're correct or not. There's a way of checking. Insert that 0.75 there. That means it will be 0.75 multiplied by 0.6 plus 0.4 into 0.4, and check are you getting 0.61 or not. This check are you getting 0.61 or not. If you are getting it, wow, that's great. But if you haven't, then you know that you have done mistake, some calculation mistake somewhere, or maybe when you are inputting the numbers in your calculator, maybe something went wrong. So you can check, right? This is called quality checking. You're checking your quality of your data, your input which you are putting in the beginning itself, so that later you don't become wrong. There's a less chance of you going wrong. Coming to the hotel service, coming to a comment. Okay, when you're putting comment, it is not now you see all these are numbers. It doesn't look it's very hard for you to go through and skim and see where is the cost of equity, where is the cost of new equity. So put this in this table format. When you have to comment, do one thing, put this in a table like this. It becomes very easy, looks neat for you to compare also. Okay, cost of equity before proposal, after proposal it reduced. WACC before proposal, after proposal WACC increased. Okay, let me show an arrow. Reduced, increased. Why WACC increased? Why WACC increased and cost of equity reduced? So your comment also has to be that. Okay, this is your starting point. This is a theory question, right? When you comment, it's not a theory question, but when you comment, basically we don't know how to comment. We know we are very good in calculation, but we don't know how to comment and where to start from. So start from your cost of equity and WACC. Why that WACC increased and while cost of equity was reducing? Okay, and you need to talk about hotel services, asset beta, equity beta, all those things you can talk about, and also your debt you can talk about in your comment. Yeah. Now, so the proposal will increase the asset beta of Coeden because the hotel services. Okay, you see the proposal. What does the proposal do to you? Start with that. The proposal will increase. The proposal will decrease. The proposal will make this worse. The proposal will make this better. This type of sentences has to be there. Okay, so the proposal will increase the asset beta of Coeden because See the word because. I'm putting it in a square. The important word is because. The link. Why? We are telling okay, asset beta is increasing after proposal. Why? That because you have to answer. That because you have to answer. Why that because is learn from here. You have a lot to learn in your revision kit, more than your textbook also. Textbook in any paper in ACCA you have to spend only 30%. 70% you have to focus on your revision kit. That is the, what do I say, a tip for passing, right? That is only a way for you to pass ACCA. 30% you have to spend time with textbook. 70% you have to spend your time with revision kit. So the proposal will increase asset beta because the hotel service industry has a higher business risk than a business that also owns hotel. Does it look practical? Does it sound practical to you when you are reading also? Exactly. Why? See, when you're having two things, hotel property, okay, think it like this. I'm telling in an easy way now. Okay, forget about AFM, forget about asset beta, everything. Hotel service industry, when you're having two business in one, right? When you're having two line of business, advantages, risk is spread into businesses. Diversification is there. When one business is not performing well, you can still rely on the other's success. But what happens when you're selling that part? You are now only relying on one business. It's risky. It increases your business risk. What happens if that business goes down? You also go down with that business. You have nothing for you to support. You don't have any business anywhere else for you to support. If it increases, it's okay. But if it goes, right? So now you're only left with hotel services. So same way, this general points only you are saying. There is nothing hard and nothing new or very complex you have to study or something. This is a very simple logic you have to just write in your words. That's it. So hotel services, because hotel service has higher business risk than a business that also owns hotel. But there is okay. But other than this general point, there is a way of showing also why hotel service alone has a high business risk. There's a way how you are saying this in financial terms, in advanced financial management. How? Just look at the asset beta. Just look at their beta value. Their beta value will tell you. When you say their equity beta, your equity beta will tell you how risky it is. We all know higher the beta, higher the risk. So before the proposal, when hotel service industry, okay, let me write here. Hotel, sorry for the spelling mistake. Hotel service industry plus property, okay, hotel property only. What was the equity beta? It was 1.1. Now what is the equity beta? Just the hotel services. 0.93. This is equity, sorry. Wait. Somewhere something went wrong. No, it should be higher because I told higher beta means higher risk, right? Equity beta. Okay, so let's go to this. Okay, you can compare the asset beta of both this thing, hotel and the property. Yeah. Asset beta of hotel is okay. Asset beta of hotel of services. Okay, I will write of services is 0.75 asset beta, but asset beta of property is how much? 0.4. Can you see that? Higher asset beta means higher risky business risk because asset beta talks about business risk. Only business risk. Equity beta includes both business risk as financial risk. That's why we are not taking equity beta here. We are only talking about business risk. That's why we are comparing the asset beta. The 0.4 is given to you in the question. 0.75 you calculated it. So when you're talking about business risk, compare the asset beta. Which one is higher? 0.75. The service. That's why service has higher business risk. Okay. Higher. It is given in bold. That means you have to talk about. You have to write this. These are keywords. It has to be there in your answer. You cannot eliminate these words. Higher business risk than a business that also owns hotel. However, the equity beta and the cost of equity are both lower. So you see equity beta 1.1 and 0.93. It is lower, and the cost of equity is also lower. From 10.6 to 9.6% it reduced. Are both lower because now you are saying because why it is lower. You are going to the second point. First you talked about asset beta that it will increase. Yes, it increased from 0.4 to 0.75. Now you are going to cost of equity and equity beta. So first, okay, for the comments, let me write the keywords. Asset beta increased. Number 2, equity beta. Okay, these are the points you have to write in your own words. Reduced. Third, cost of equity reduced. Okay, you're giving reasons. You're saying something, giving reasons. Saying one line, giving reasons. Why it reduced? Because of the reduction in the level of debt. It is even it's in bold again. This has to be there. These are points. Higher business risk 1 mark. Reduction in level of debt number 2. Second mark. Debt reduced. Before, how much was the debt in the balance sheet? C, 42 million. After you are paying 70% of non-current liabilities, how much it is? 12.6 million. So your debt reduced means your financial risk is reducing because your equity or cost of equity beta both includes what? Financial risk and business risk. Yes, your business risk is increasing by cost of asset beta, but your debt is reducing. That means your financial risk is reducing. So that increase maybe is not so much, but that reduction in debt was so much that your overall cost of equity and your equity beta went down. Now, this is because, okay, these are the same things which I explained in words just now. This is because the reduction in debt means that the financial risk. Yes, debt means financial risk. Debt has a connection with financial risk. Financial risk of Coeden is lower. However, the WACC increases. Now, the fourth point, WACC increase is the fourth point. This should be in your comments. WACC increase. Why WACC increase? Because this lower debt level means there's a less cheap debt in the financing mix. What happens when there's a less debt in your formula of WACC? We all know the more debt we have, the more advantage we can take of the tax deductible. But if we are having low WACC, we cannot take advantage of tax. That is the reason why WACC increased. That advantage is we are losing that advantage now of tax, because equity is nothing. It has nothing to do with tax. It cannot take the advantage of tax. It is not tax deductible, but debt can because of the interest. So cheap debt, less cheap debt in financing mix. We don't have much debt now. That's why WACC increased. All these things you have to know. Whenever question about a calculation part comes, right? You have to be sure that you are also going to get a theory part. You have to explain that. Why that increase is there. For that explanation, these points you have to understand. Most of the time in the question paper, you will see these are the only points, common points only. So you can keep in your head these points. Okay, and don't forget. As the result of the board of directors assertion that lower level of debt will reduce the WACC is incorrect. This last line here, what does it mean? As a result of the board of directors assertion that the lower level of debt will reduce WACC is incorrect. What did they say? They told that lower level of WACC will reduce WACC. Is it correct in this case? No, it's not. We saw WACC increase. So you should say it's incorrect. Their assertion, it's an assertion. Where did they say? Let's go and search. By this time you forgot also about that assertion where they told, right? It's easy. Nothing to worry. You can always refer to the case study and see, but not in the exam. In the exam, you have to be very once, because you are reading it once only, the whole case study. So you have to read it in such a way that you retain most of the information in your head. Okay, the small pieces of information. So I'm also searching it for that line. Okay, part B also is very linked to A. Okay, but we'll come to that. It's just for 5 points so that we can quickly finish. But that line has to be, I have to search for that line. You see how much time I'm wasting here? Because I didn't note it or I didn't underline it anywhere. That's the reason now I am taking so much of time. Okay. Okay, yes, I got it. So the board of directors is of opinion that reducing the level of debt will reduce the company's risk and therefore cost of capital. This line. Wrong. Incorrect. Now you can tell because you have done the calculation. Before, if you had to tell, you couldn't tell. And it's just for one line. You don't have to explain pages and pages. Coming to part B. Part B, you have to, what should you do in part B? Discuss the validity of the assumption. How validate are your assumptions which you made in part A? That the market value of equity will remain unchanged after the implementation of proposal. Because it's very unlikely that market value of equity will remain changed after proposal. So how validate is your assumption? Right? For 5 marks and for 3 paragraphs. Let's read. The assumption that the market value of equity will not change is unlikely to hold in reality. You see, when you read it by yourself also, you will not feel satisfied. That how come it is? So the change in the growth rate of free, since this is a theory question and one of my students asked me to make a video on theory question, how to, there are two types of theory you have to remember. Okay, one type of theory is which is related to your numbers, calculations which you do some calculations and discuss and comment on that. That is one type of theory, which is theory only, you need numbers. And the other type of is an independent standalone theory questions, how to answer it. I will be making quite shortly, I will be making a video, separate video on that. But for right now, this is also a theory question, kind of theory question, right? Discuss the validity of assumption. This is one type of a key question which an AFM student should always be prepared for, right? Especially when a question like this is given, state your assumptions. In part A, if you see, state your assumptions. So in that type of question, you can see the next part will be discuss the validity of assumptions. This is the second type of question which you can expect after that question. So your assumptions, how you are going to validate, you have to be ready for that. So now I'm going to tell you how you have to come up with points. Is for 5 points. That means you have to give five marks. That means you have to give 5 points. Okay. First, you have to say it will not change. Is unlikely to hold in reality or likely to hold in reality based on your opinion, right? But let me tell you, if you say that it's likely to hold in reality, you have to explain points, and to give those points, it will be very hard for you. So it's always better when you're learning, don't try to go opposite to the answers which is given to you. Don't try to go opposite the examiner's answers. Go with them. It is better because that's why they are giving those points, right? Otherwise, they would have given points for the others also, likely to hold in reality. So don't try to go opposite to them, because then you have to come with your own points and it will be very hard for you to get marks and come with your own points. Trust me on that. So just always go with the examiners. Whatever the answers they give, go with that flow. Go in that way where you have an option to go with this or that. Whatever the examiner has written more about, where they have more points. In this case, they are saying it is unlikely to hold in reality. You also go in that way only, unlikely to hold in reality. Because then you can use these points which they have given you. Because if you tell, you can tell it's not wrong. You can say assumption that the market value of equity will not change is likely to hold in reality. You can say this also, you will not, your marks will not be cut for that. You will get marks. But then you have to do your own research and come with answer, because nowhere in the marking scheme they have given for it. And I also, if you tell me to mark your answers, I cannot do that because I don't know the answer for that. It's like the majority. Okay. Okay, so coming back to our point, unlikely to hold in reality. Okay, what were your assumptions about? What were your assumptions were about before? For that, you have to go to party and go through your answer and see the assumptions. We talked about growth rate. We talked about growth rate assumption. That was one assumption. What was the next assumption? Market value of equity and debt is close to 50-50. We'll see whether they have put that in answer or not. I also haven't gone through in answer in advance. This is the first time I'm going through this answer with you. Next, this assumption. Asset beta is a weighted average cost. Okay, has been assumed. So this is the third assumption. So that means I'm getting 3 points to discuss. You see how I'm getting points? 5, it's for 5 marks. Search for some more assumptions. Okay. Okay, I think these 3 points are there. Okay. So first paragraph, they're talking about free cash flow and the growth rate only. If you see, the change in the growth rate of free cash flows and the sales revenue and the changes in the business and the financial risk of new businesses are all likely to have an effect. Right? Changes. You have to discuss the validity. That means you have to talk about changes only. What happens if they change? They are likely to have an effect. So you're talking about the growth rate. You're talking about the sales revenue and changes in business and financial risk of new business are all likely to have an effect. Second, in estimating the asset beta, second, okay, in estimating the asset beta for offering hotel services only, there has been no consideration of change in business risk as a result of renting rather than owning the hotels. Okay, wait, let me read again. There has been no consideration of the change in business risk as a result of renting rather than owning. Yes. How are you getting this point from your case study in the first paragraph? They told now before you are owning the hotel property, now you are selling and renting it out. You are selling and renting. So what happens? There's a risk. Isn't there a business risk? Because now you are not owning it, renting it. Isn't there a risk there? So did we consider that business risk? We didn't consider. This is why reading the whole case study from point to point and remembering everything is very important. You don't know from where you have to take the information. Maybe it could be from the first line, maybe it could be in the last paragraph, it could be from anywhere in that passage. You need all piece of information. So that is one thing. How, okay, so most of you might be thinking, how do I know that this is the thing I need to write, or how do I know these points? Because when you write, you never think of these points, and when you see your answer script, totally different answers, which amazes you also that how they think so much. The reason is that because this is why when you first attempt a question paper, you will be very poor, you'll be very bad. You don't know what to write. It's very important for you to practice the theory questions more than numbers, because numbers is easy for you to calculate and only you will do it. Theory you actually have to write. Theory makes you think out of the box. You have to think out of the box also. There are many things like that. How to use. So in this, if you have to find points, because this is from case study, it is not from anywhere outside. Keep reading the text from your study. Sorry, case study. The first few lines. Usually the answers are in the first few lines only, first few paragraphs. First paragraph or first two paragraphs. The answers lies there only for more points, which you haven't covered in any part of the requirement. Like this, renting, about renting and all. This was in a first paragraph. So the more you read, keep reading, you will get points. The more you do questions, you will get better and better in writing your theory answers. But you actually have to sit and write. Time yourself. You have to write in time. 1.8 minutes per mark. This is a 25 marks paper. So that means 25 into 1.8, 36 minutes you have to write on this. You also have to time how much time you're taking to think and how much time you are thinking to write. There is no difference. Extra time you are getting. You're thinking, you're planning the answer, you're writing, everything comes in that 36 minutes. That means you have to think faster. You cannot waste so much of time. You cannot waste 10 minutes thinking and only 5 minutes writing. If it is 8 minutes, let's say, 2 or 3 minutes you are thinking, the rest 4-5 minutes you are writing only. It should be like that. It's not that you are thinking 5-6 minutes you are thinking and 2 minutes only you are writing. And it should not be this also that you are only writing, you are not thinking at all. It should not be like that. You at least need 1 or 2 minutes to think. When you come from next question to another question, you need to refresh your mind, reset your mind, and come to this question and think about this. Because when you're attempting one question, your mind is always in that only, where cost of equity. When you come to second, you're again thinking about those points only. It's very hard for you to switch. You need time for that. Okay, and you have to, and that change from question to question, the swift in mind has to be very fast and very quick. You cannot take 5 minutes to come from here to here. In 1 or 2 minutes you have to get settled. Okay, so that is another point you are getting there. So a revised asset beta should be estimated to reflect the change in business risk. They should be estimated to reflect the change in business risk. A revised asset beta. They are discussing the validity, right? Last paragraph, the market value of equity. Right. Market value of equity, that was another assumption. So the market value of equity will not change. That was their assumption. Market value of equity has been used to estimate the post-implementation equity beta and cost of equity of the business. How did you use? What did you use it? That's you use this market value of equity for what? To find equity beta and cost of equity. Post-implementation, after the proposal. So, however, the market value of equity is dependent on the cost of equity. You have to write this dependence. Okay. Market value of equity, you told it will not change. So based on that, your cost of equity depends. You have to write this. Market value of equity is dependent on the cost of equity, which is itself depend on the equity beta. You see that link? Okay. So equity beta will give you what? Cost of equity. Cost of equity will give you what? Market value of equity. There's a link. This is a chain. This you have to understand. In any question it is like this only. It will not change from question to question. So this you can memorize it also. Equity beta will give you cost of equity. Cost of equity will give you market value of equity. Right? So your market value of equity is dependent on cost of equity. Your cost of equity is dependent. You are going backwards. Therefore, both the cost of equity and market value of equity will change. That change is in bold. That means you have to write the word change. Cost of equity and market value of equity will change as a result of the implementation of this proposal. Okay, will change as a result of the implementation of this proposal. That means because of this proposal, they are trying to say it will change. Cost of equity and market value of equity. Why it will change? Equity beta changed, right? Equity beta before was how much? 1.1. Now it was 0.93. So if equity beta change means cost of equity will change. If cost of equity changes means market value of equity should also change. But it didn't change so. Right? Now let's go through the marking scheme and see how it is marked. This is the end of this question. First we'll take you through the marks. 20 marks how you are getting. If you see the marking scheme, oh my god, it's quite long. So prior implementation, 1 mark for cost of equity because it is just CAPM. Cost of debt, easy calculation is always 1 mark. Wherever you require workings, 2 or 3 marks will be given. Market value of debt, 2 marks. You need to find market value. You have to do calculation. First year, second year, third year. Market value of equity is 3 marks. 1 mark extra because more calculations for equity. Free cash flow to equity, then growth rate, all those things. And then WACC finally is just 1 mark because just you are putting the numbers. No extra working. That is before. After implementing the proposal, okay, asset beta is 1 mark because asset beta you're just using the formula and finding it. But when you come to the next one, equity beta of hotel services and equity asset beta of hotel services, only 2 marks each. 2 marks each because it requires working. It is not directly found. Then cost of equity is just 1 mark because you just have to put the number in the CAPM, and WACC is 1 mark only. Assumptions, discussions, most of your marks is here. Yeah, assumptions and explanations, right? Which is your discussion, 2 to 3 marks. 1 to 2 marks per explained assumptions. If you are writing one assumption, 1 mark, 2 assumption, 2 marks. So that's how you are getting the 20 marks. Part B, 1 or 2 marks per point. If it is 1 mark, write 5 points. If you are explaining in detail, write 3 points. 3 to 6, because if 1 point is wrong also, at least you will get marks. Okay, don't write less. If you are writing 2 points only, 2 into 2 is 4 marks only. But if you are writing 3 into 2 is 6. Even if you require 5 only. So write more than 1, because it's hard to divide that 5. Okay, now coming to this. Main thing is cost of capital only. Top tips. There are series of related calculations to get the answer for the post implementation WACC. Series of questions, you saw steps are there. It may not be immediately obvious how to get to the final answer. To get to the final answer, your step has to see. To get to the final answer, this has to be your goal in your mind. Don't just start immediately answering the question. Okay, in your mind, make a plan. How I'm going to start, where do I end, what are the steps in between I need to get to that final answer. In between, there are so many steps for you to find that final WACC. So many. First, you have to find cost of equity, cost of debt, all those things. You have make a note. What are the things you have to find out? And see the marks also. Mark it by yourself. Cost of equity 1 or 2 mark, cost of debt, like that. You see, you will get the marks. If no workings required, 1 mark. If workings are required, put 2 marks. So that's how you yourself can see how much you're writing, how many marks you are getting. Okay. If you cannot see how to get to the next stage, start a simplifying assumption and move on. Move on is very important. We always get stuck somewhere and we don't try to move on. We try to get that answer somehow. Until we don't get that answer, we are stuck in that question. Don't do this mistake. It will cost you a lot of marks. Trust me. It's much better for you to stop that question there itself, whatever you have calculated. State an assumption, move on, and go to the next question. If your time is up. Okay? State a simplifying assumption, any assumption. Now, before implementation WACC is straightforward. So these are some easy marks. That means before implementation you are getting less marks, but for after implementation, the calculations which you are doing, you are getting more marks. So you have to be more critical of that. That after implementation your working has to be, you have to be more accurate to get more marks. The requirement for part B. Always read all your requirements together, one after the other. Don't read requirement A, then try to answer that question, then read requirement B. Don't do that. Once you read requirements and then you read case study, you know, okay, this is what I'm finding for. And also it helps you to answer also your previous question if you read the next requirement. So the requirement for part B gives you a clue that the assumption is highly questionable. Highly questionable. You read requirement B, discuss the validity of assumptions in part A. So now you know that whatever assumptions you are doing, later you have to discuss it in part B. There's in back of your mind, it is there, it is set. So when you come to part B, you don't have to spend so much of time trying to find answers. You directly can start answering and save time, because you know what are the assumptions you make in part B. Part A, part B, you have to go and discuss it, how validate it is, and also it gives you a clue also. So that's it for this question 21, and one last question is there for this investment appraisal topic. After that, I'll be switching to mergers and acquisitions. There I have 4 questions to do. Hope, and after that, hopefully, I'll be starting with my 50 mark question series. Right, I'll be doing 50 marks question, how a 50 mark question is answered, because your professional marks is there, the 4 professional marks. I'm going to teach you how to write a report making. One student asked me how to make a report, so for her and for everyone, all of you, I'm doing this. So don't miss out those videos. That's why if you haven't subscribed to my channel, do subscribe now, today, and let others know it about it too. Thank you, take care, God bless.